Hello, welcome to Money Matters. My name is Dave DeWitt with DeWitt Capital Management. My co-host tonight is Dave Emery, CFP with Marshall Financial Group.
Nice to see you.
Good to see you, David. So let's get started right away. I'm kind of interested in your business and how you work with clients to help them manage their finances and specifically what it is that you do.
Yeah. I guess, there's a number of things. We're a fee-only financial planning firm. And one of the big areas that we help clients with is, that I'm seeing more and more, is retirement income planning. And really it's clients that are anywhere from 10 to 15 years from retirement or at retirement. And what we do is we help them understand where they are, help them understand, have a conversation on what retirement looks like, and then talk through how do they get there, and once they're there, how do they sustain it. I mean, so there's kind of four big pieces that we help them with. And a lot of times people don't realize, but there's putting all the pieces of the puzzle together is challenging. And one of the first questions we ask them is, when you do a jigsaw puzzle, what's the first step? So I ask you, what's the first step?
I would say I'd find a corner piece.
Well, that's what we hear a lot, but really the first step is looking at the picture on the box.
Oh.
So and the picture on the box signifies what retirement looks like. So once you see the picture, then you start putting in the corners, just like you said, framing it out and then putting the pieces together.
Right.
So
I would imagine when people come to you, they might have just sort of a mixture of all sorts of different things and no real coherent plan.
Right. Yeah, absolutely. I mean, there's a number of pieces. They kind of know the pieces. You hear the pieces like Social Security and investments and maybe pensions. But one of the big pieces, which probably goes to what you folks do, is MLPs. So that's often a piece of the retirement puzzle. So tell me a little bit about what you do.
Right. Well, we invest in energy infrastructure, and a lot of that is in the form of master limited partnerships. And they, from that period of 2014 to 2016, became correlated with the price of oil and brought the price of the MLPs down. They are companies, they're just simple companies, and they transport oil or natural gas, and they separate natural gas into the liquids, and they ship oil and natural gas. These are ongoing businesses that it really shouldn't make a whole lot of difference what the price of oil or natural gas is.
Right.
They still got to move it, ship it, process it, refine it, and do all those things. So they were unfairly cast as an oil substitute in terms of pricing on the market, and they're still undervalued if you look at them according to any sort of historical metric.
I see.
In fact, if you look back from 1998 through the end of 2016, it would be the top performing asset class, beating the S&P 500, REITs, emerging markets, the whole.
Fantastic.
Yeah, but you wouldn't recognize it.
Predominantly here in the United States, I mean, with all the, in the news with energy and the new administration, it seems like it seems like there's a promising future.
It does look good. I think the second day after Trump became president, he announced that he wanted to go forward with the Dakota Access Pipeline project and the Keystone XL project. And those are all revenue generators for the master limited partnerships that invest in these projects. So they're moving from the expense line to the revenue line, and people can get yields of anywhere between 4% up to 10%. And these are real yields covered by real cash flows. And in fact, some of them are paying, like, they could pay out twice what they're paying out, but they don't because of this. When this recent implosion in prices occurred, it didn't make. They could be earning 30% and actually earning it, and people would look at that. Wall Street looks at that and says, that must be very risky. But if you look underneath the surface, they're actually earning that money. So they cut their some of them cut their distributions because they weren't being rewarded in the market for it. And when they cut their distributions, the prices would go up by 60% because now Wall Street says, wow, they're only paying out half what they could, and they're building up their balance sheets, and they're lowering their leverage, and all of a sudden the same company, same horse, but look different. So I've been investing in them since 1991, so I've seen everything.
Yeah, you know your way around it. So I think I recently heard that you wrote a book.
Yes, I did. I wrote a book called Master Limited Partnerships.
That sounds like it's right up your alley.
Yep, yep. Yeah, my wife helped me stay focused on this. And I had some help with people that helped me stay focused on this project, and so it wasn't it wasn't me alone.
Yeah.
A lot of editing, a lot of reviews.
Quite a learning experience, I'm sure.
Yeah.
First book?
Yes.
Gonna do another one?
I might add a chapter to this one. I don't know if I would do a whole new one.
Yeah. So, Master Limited Partnership, the tax component. You know anything about the tax component?
Yeah, the way it's a little bit different than a C corp is that
I remember hearing something like this.
Yeah, what happens is, well, it's a limited partnership, so there's no tax at the corporate level. So and the pipeline companies are pretty capital intensive. It costs a lot of money to put a pipeline in, so they depreciate that asset over 20 or 30 years. And so investors get that depreciation, and it comes in the form of a K-1.
Okay.
So some people don't like that. Some people don't like to have a K-1 because it complicates filing their tax returns.
Yeah, sometimes it takes some, at least I've seen K-1 say a lot of times they have to file for extension because it's...
There's sometimes not as quickly as getting a 1099 out, but essentially 80% of the money you get will be non-tax, technically return of capital from an accounting standpoint. I mean, they're earning the cash flow, but it's depreciation that's covering it. So you can own them for a long time and get non-taxed income, but when you sell them, then you pay the tax on the income that you did not pay tax on.
I see.
So, and there's also complications and variations in this. They're not the most simple investments out there.
Right.
Because there's passive losses involved in it. But if you have an accountant that can handle this for you, it's a great way to get tax-deferred income.
And with people looking for retirement, retirement income planning, I mean, one of the things we do is we help consult on the tax side of things. And so understanding the different pieces and the tax impact and how to, just understanding and how to limit it can go a long way to making your money go further.
Yeah. Now you also do other things too, don't you? Specialties?
Yeah. So one of the other areas I also focus on is college planning. With regards to help clients understand, families understand how to reduce the costs associated with educating their children.
I could have used you 10 years ago.
You could have, huh? Yeah. Because college just continues to get more and more expensive. And, the one thing people don't realize, I didn't realize till I got into the business, is it takes, today the average time to get a 4-year degree is 6.2 years. So if you're planning on paying for 4 years, most of the times the students are there longer.
Really?
So that, basically what college planning is, it's a retirement planning problem, because once you get through paying for education of your children, right behind that, oftentimes clients are looking to, the next milestone is retirement. So,
sure.
So if we can help them reduce the size of that, that expense, you're further along the way to funding your retirement.
Yeah. Well, if you can stop spending money for college and keep that money for your retirement, then
that's right.
Yeah. And hopefully your parents aren't needing your support as well.
Yeah,
I mean, that's that middle generation that's stuck in between.
That's exactly it, and that's really the sweet spot you kind of hit on. I mean, that's what we're really helping clients with, the sandwich generation.
That's right, they call it the sandwich generation.
Exactly. So I mean, it's helping people with regards to reducing college costs, and then also helping they're helping their parents. I mean, I have a lot of clients that are transitioning to a continuous care retirement community and understanding all the different facets of that. Where are you going to live? How's the finances going to work out? How are you going to transition from a home you raise your family into something that's much much smaller living areas. So.
All right. Well, we could continue with this conversation, but we have a question from one of our viewers. And I think it might be right down your alley.
I think it might. I think I heard.
Let me see what this question is. The question is, any new tips on getting college scholarships?
College scholarships.
That's from Kelly Samuel from Marion.
Okay. Yeah, that's a great question. I guess the way I'd answer that is, I guess one of the biggest avenues of reducing college costs is accessing financial aid through the schools. Grants, they call them either grants or scholarships or awards. And I'm not talking about the scholarships where I think Coca-Cola has a scholarship. I'm not talking. I mean, there's a lot of companies that have their own scholarships, but a lot of times, I never discourage people from going after them, but oftentimes it's just very competitive.
Yeah.
So the areas where you really may be able to have a higher probability for success is understand the financial aid system.
Yeah.
So they also call those scholarships too. So to answer the question that way, one of the big areas that's happened with financial aid is this form called FAFSA, which is the Federal Financial Aid Form, and part of that is it gets populated by your tax information. And there's something that the government started probably about 3 or 4 years ago called the Data Retrieval Tool, which actually goes and accesses the IRS database and pulls your income data into the FAFSA form.
Oh.
Well, what I've seen is, well, quote, yeah, it's supposed to make it easier, but what I've seen over the last handful of years, there's a couple of areas where it does not work correctly and it negatively impacts a family's financial aid system. Well, the big news in the industry right now is the government has stopped using it for the 2017 school year because of this. So
okay, I remember when I was looking at the FAFSA form, I absolutely hated it.
Yep.
Because if you file for an extension, you don't have the data, and then you have to put all these numbers in there.
And then go and tweak it out. Yep.
You know, we're going to have to. We want to get to our special guest.
Right. We could talk all day on that one.
We could, but they can always call you. And,
that's right.
And,
absolutely.
Find you. So, if you have a question for Money Matters, here's how to get your question in.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, M-O-N-E-Y, -matters, M-A-T-T-E-R-S, TV.com.
Now here's our special guest, Mark Blair, certified financial planner, CHFC and CLU, so you have a lot of designations, professional designations, so that's a credit to you.
Well, thank you.
Yeah, and I know how difficult it is to do these things. Mark, you're the president of Blair Wealth Management. Tell us about your journey and how it led you to where you are today, and what were you doing before you started your firm?
Well, Dave, thanks. And by the way, I enjoyed your conversation. Very interesting, especially the part about the oil business. And so I'd like to talk more with you about that.
Sure.
But I've spent the last 25 years of my life on a journey to get to the point where I can offer my clients the highest level of excellence and trust. The CFP designation is a big part of that. I spent 10 years at a large investment advisory firm where I learned the investment business. I went beyond the CFP to get, you mentioned the Chartered Financial Consultant designation and also the Chartered Life Underwriter designation. I don't sell insurance. The only thing I sell is advice and financial planning services like Dave does for fees. But to understand the concerns of small business owners and wealthy families in terms of succession planning and so forth, it was important to me to get that additional insight from the insurance courses. And I continue to pursue other accreditations from the college, which is conveniently right here in Bryn Mawr. It's great. Meanwhile, then about 6 years ago, I set up Blair Wealth Management as an independent registered investment advisory firm. We'll talk later about this fiduciary question.
Sure.
But being unencumbered with any relationship with another firm means that all of our advice, which has to be in the best interest of clients anyways as a registered investment advisor, I have absolutely no incentive to do other than that. So, and along the way, I've studied what it takes to be human, what it means to be human, how to communicate, and so forth, and I find that's very helpful in educating and coaching our clients.
That's great. So tell us a little bit about your client philosophy and what clients do you enjoy working with?
Well, as you know, you guys are both experts here. The essence of financial planning is aggregating all the data, pulling it together, and first allowing the client to understand what's their current situation, and also what are the likelihoods of them reaching their financial goals for retirement and other goals, and what they might do to change that. One of the things that we look for in a client is the commitment to help us gather the information we need. If we don't have a complete data set, we can't offer useful, grounded, excellent recommendations to them. So we always talk to them about that, and we really do need their help, and it takes some time. We find that if someone, say a millennial, may be more organized than a baby boomer, they can give us the data, no problem. We can do it in a week or two. But some of us baby boomers, well, you know, it takes a little more effort, and we'll follow up with emails and phone calls to get clarifications.
Well, I think the digital revolution, that the millennials grew up with it, and we're somewhere stuck between paperwork and digital.
Yes, that's right. But we understand that, and that's fine.
Sometimes, you know, sometimes people avoid dealing with their finances or investing because they feel overwhelmed by numbers and have no understanding of stocks, bonds, or mutual funds. How do you help your clients walk through this process?
Well, first of all, I expect that most people who call on us for help don't understand these complex topics. And that's okay. I don't expect them to. And I also know that it's difficult for people to ask for help in these matters. Money is an area of our lives that we don't feel comfortable talking about typically.
Right.
So I get that out on the table first off. And I have developed ways of just communicating the simple aspects of, say, investment alternatives to distinguish stocks from bonds and ETFs and mutual funds and all these things. And it's kind of an alphabet soup for people, but through our initial conversations, and then if they choose to work with us on an ongoing basis, the education process continues. And the financial planning report format that we have is, I think it's pretty understandable. And as part of our concluding conversations, we work through with them so that they can understand it, not just put it on the shelf.
Sure.
If we're managing their money, we also have a standard format of reports that we issue prior to each conversation, typically monthly or more often. And I train them to understand it so that when they receive it, they don't need me to help them figure it out. But we always talk about it. And when new things develop, we talk about it. I firmly believe that I won't do something that my client doesn't understand. And although I tend to work with full discretion, I always believe in talking with my client and helping them understand what we're doing and why.
Sure.
So that, you know, it's really a collaborative effort.
Right.
No mysteries.
Yep.
And if I don't understand it or they don't understand it, if I can't explain it to them, we're not going to buy it.
Right.
It just doesn't make any sense.
Yeah.
So it seems like the paradigm has shifted from alpha to more of a conservative approach to customized solutions. What do you think about that?
Well, I think that is happening, and I think that, well, for people who aren't familiar with it, the alpha approach is seeking excess performance beyond the general market. And of course, it's great when that happens, and sometimes it does. Apple recently has been blowing the doors off. But in general, our belief is that if people have developed a discipline for setting aside money and invested in low-cost funds, which largely due to Jack Bogle and Vanguard are very available now, and he has also helped spread the word that if you can just put the money aside, not spend it, and then invest it in low-cost funds, but you also want, and this is where we can add value, is to help people understand their risk preferences and their risk tolerances. Sometimes people want to be more aggressive, but by looking at their financials, we can say, we really don't think you're in a position to take that risk, especially when people get older and kind of feverish to make more money in the market.
Real fast.
That's where the behavioral finance part of things comes into play.
Yeah.
Yeah.
Well, financial literacy among clients remains a problem. With more online tools, including home budgeting, apps, robot, investment portfolio, and educational apps. How do you think these platforms help like gamify or the financial planning experience, or potentially creating more savvy, educated investors? Do you think it's helping or hurting?
Well, I firmly believe it's helping. These tools I view as educational.
Okay.
Anything that helps, especially young people, but older people, bridge the gap between their understanding and make it fun instead of some self-negating conversation, I should know this or whatever. If
Sure.
they can play around on an application, it's great. And I know when I first left the Wharton School, I teamed up with one of my professors, and we used the Wharton management game to train executives in finance and strategy using this computerized simulation. And two things were pretty amazing. One was the ease with which they quickly began to understand income statements and balance sheets and how the effects of operating decisions in running a business affected the income statement and balance sheet. And the other thing was the level of engagement. We had to get these guys and gals out of the room and like close the doors because they just wanted to work and, you know, collaborate and figure out how to make their next set of decisions. So I think it's fabulous, and I don't think that's the whole answer to things. Again, we talked about how some of these more complicated topics need help from an expert, but Mint, for instance, is an application that's available, and people can use it to start to set up their home budgets. They can hook their accounts into it. It makes it easy to be reminded when to pay bills, all on your phone or your iPad or something. I think that's great.
Yeah.
So let's talk a little bit about the fiduciary rule. What are your thoughts on that?
Well, I think it's a good idea for the fiduciary. In fact, my stand is that everyone should be served by someone who has a fiduciary responsibility. And that's because, in its simplest form, the difference between a broker-dealer type representative or unlabeled financial advisor is that they are compelled to make investment recommendations that are suitable for that client's asset or risk preferences and tolerances and so forth. But suitable is not the same as in the best interest.
Right.
And in the best interest is kind of like making a recommendation for your mom or dad or your daughter. Like, you want to look at something that is, of course, suitable. But if you have the opportunity to use, for instance, a Vanguard fund and save 20, 30, 40, 50 basis points, or like 0.5% in terms of the ongoing cost, with no front-end loads or back loads, which would you buy for your daughter? And that's always been my position. That's why I'm a registered investment advisor. I have to perform up to that standard. That's the state law.
Right.
Yeah.
Do you find your clients really understand the whole fiduciary and suitability differences?
My clients do, because I talk to them a lot about that. I want them to understand the quality of the advice they're getting. I also write extensively on it. In fact, my February newsletter, which is available on my blog, let me put a plug in for that, blairwealthmanagement.com, goes into great detail to explain those subtleties and also the different players, hybrid RIAs versus straight RIA like myself. So that they have yet another opportunity to understand the complexities. Something I want to be sure to mention is that if that law or regulation is put in place, which isn't certain, a couple things will happen. First of all, investors should know that it only pertains to tax-sheltered accounts, like 401ks. So you could conceivably be dealing with someone who, if they're not adhering to the fiduciary standard in all their dealings, now they must legally do that with your retirement assets. But if you have taxable accounts with them, which is common, they could revert back to that suitability standard, which might mean, and there are many good people out there, that they would recommend products sponsored by their firm that helps them meet a quota or something like that. So it's not the answer to everything, but personally I think that everyone deserves to be served by someone who observes that standard.
Fiduciary standard.
Yes.
I have this feeling that we're going to be running out of time here soon, so Do you think the current 401k fee structures, disclosures are enough to fully inform savers or retirees that what they're paying for their accounts? Do you think the current disclosure is enough?
Well, with respect to fees, I think
it's
a good step forward. To have that information show up on someone's doorstep in an envelope that hopefully they'll open, and hopefully they'll understand and be able to put it in context. I don't think that it is everything that they should know. Performance over time compared to a benchmark, there's other important characteristics of potential investments that people should know. Right now we're focusing on the expenses. So, you know, that's the Vanguard Jack Bogle thing. They've brought that into the foreground. I hope eventually people are educated in these other areas in the same manner. It's a good thing.
We have about 1 minute left, and so I just one real quick question. With Americans enjoying increased longevity, what methods are you using to help clients create savings to last them through those long retirement years?
Okay. Well, I could give you a list.
Yes. 1 minute.
Just give it's a great time to be alive because of the medical technology, but that can be a good news, bad things from a financial prosperity standpoint. First things, work with a certified financial planner, get a plan, strategize with them. That's a huge improvement for most people. Secondly, have that home budget if you don't have one already. Adjust your expectations. Take care of your body by walking a half an hour each day. You'll sidestep dementia or limit the odds. And wait till you're 70 to claim your Social Security. You'll give yourself a 24% increase in an inflation-adjusted annuity. And look at other possibilities to set up ongoing streams of income.
Well, it's been great talking with you, and we'd love to have you back again and talk more.
It'd be my pleasure. Thank you very much.
So thank you for joining Money Matters today, tonight, I guess it would be. And our next show will feature Mark Mulholland of the Matthew 25 Fund. Thanks for watching Money Matters. Have a great evening.